G'day, Chris. Just checking on Rio Tinto. Have we bottomed yet? And technicals and an entry point.
For me, with Rio, is that its valuation is significantly higher than the share price today, but based on expectations for earnings over the next 3 years, the return on equity, it's interesting, a lot of analysts follow earnings per share growth, and they believe that there's a strong correlation between share price performance and earnings per share growth. I think that's true in the short term, but in the long term it's profitability, not profits, that share prices tend to track. And so it's return on equity that I'm more interested in. And return on equity for this company is going to go from 28% in 2011 or thereabouts to 18% in 2013, 2014. So that means my intrinsic value for this company is going to fall substantially. In fact, so much so that it'll drop from something like $94 or thereabouts currently to about $85 in 2013. Now the share price today is 81, so there's $4 of intrinsic value potential gap, the arbitrage between the price and the intrinsic value, but over the next 2.5 years. So there doesn't seem to be a lot in it for me. I'm not that excited, and I'm certainly not as enamoured as many analysts at the moment.
What I do like today, and before we go to a quick break, what I did find very, very appealing for a company that makes 70% of its earnings from iron ore was that the Chinese are going and putting a pretty fundamental bid on for Sundance Resources. That says to me that they don't see the iron ore price collapsing anytime soon.
Can I just respond to that? Because there's something we talked about on your show earlier in the year. Back, I think it was on January the 4th or January the 11th, the Chinese actually made an announcement that exporting companies can keep their foreign earnings offshore and invest that money. I think a lot of the takeovers that we're seeing are actually a function of that now, rather than their expectations or predictions about iron ore prices.
We're going to go straight into a call. We've got Jeff from Brisbane. Welcome to the program, Jeff.
Yeah, hi, thanks panel.
Pleasure.
Look, I'd like to get the panel's view, if I could, on two stocks, CCP, Credit Corp, and CNA, Coal and Allied, and I'd like their views on whether to keep holding those or not. Thanks.
Two very different stocks there. So we've got Credit Corp and Coal of Africa.
Was it Coal of Africa or Coal and Allied?
It's Coal and Allied.
Coal and Allied, sorry.
That's okay.
I just want to bring up the carbon tax.
Sure, love to talk about it.
Because I think it's pretty ill-timed myself, and obviously Julia Gillard's ratings at 26%, the lowest they've been for, well, ever, I think, is probably testament to that. I'll just start with the sort of fundamental view. I mean, how do you think this is impacting a business like Coal and Allied? Obviously, they all have offsets, but would you see this as keeping away foreign investment into a company like this?
Yeah, well, look, let me say this, and we're leaving investment discussions at the moment. We're heading into political territory, and that's fine. It's a free country, fortunately. We have the luxury of saying what we think.
Yeah.
I think if people cast their minds back to the election, and just before the election, Julia Gillard said there would be no carbon tax with her government. So why is there one now? Political expediency. In order to get the Prime Ministership and to get Labor in power, she had to make a deal with the Greens. If you're making a deal for political reasons, then it's not to do with the environment. It's for political reasons. So any compromises that you make in order to get that deal over the line is not going to be the ideal scenario for the environment. I also believe that if you rebate producers of carbon and you rebate consumers of carbon, then there's no incentive really for them to significantly change their behaviour. I was told today at a lunch that one of the upshots of what's happened is Chinese companies can purchase Australian coal, which is cleaner than Chinese coal. They will get a credit worth billions and billions of dollars because they'll get a carbon credit, if you like, because they're using cleaner coal. They'll be able to sell that credit back to Australian producers who will buy that credit to only produce more coal. Yeah. So I think there's a lot that's not good about this particular structure, and I think it's going to be some time before we see something that's ideal. Yeah. Now, in the meantime, it's costing consumers more, it's costing companies profit, and there's a huge amount of uncertainty. None of those things are positive.
Actually, we've got an email from Tom Green. He writes, Acrux is a drug development company that appears to be achieving good results with innovative products. Could you please give me your assessment of this business? And the chart appears to be in an uptrend as well. So the ticker code for that is ACR. Wonderful. Do you know much about this business?
Yes, and in fact we know a reasonable amount about this business. Historically it's been very lumpy in terms of, it's received special payments. If you filter those out, there's an expectation, I guess, over the next couple of years that profits will average about $50 million over the next 2 or 3 years. But they'll swing from 68 million down to 42 million, back up to about 61 million. So what does that mean from an intrinsic value perspective? We think it's worth probably about $4.55 or thereabouts, going to $4.76 over the next couple of years. So we like it. It's an A1 company.
From Marsden. Welcome to the programme, Glenn.
Yes, how you going, Chris?
Very well, thank you.
Mate, I'm lightweight media at the moment, so I've been, like a lot of people, keeping an eye on News Corp. It's obviously had its backside smacked recently and a slight bounce today. I'm wondering whether the pain is over and it's time to add that to the portfolio. I've got Roger's book, and even with the wisdom I've gained from that, this stock appears to be a fairly difficult stock to value, more so in the current climate.
So, caller, we've got Charles from Sydney. Welcome to the programme, Charles.
Thank you very much, boys, for taking the call. It's just in regards to a top 100 company, Lynas, LYC. There seems to be a lot of mixed signals coming out at the moment, particularly with the Malaysian situation, whether China might come back online with more rare earths. And I'm just wondering whether there's going to be a lack or a surplus of them. And I'm just wondering what the panel thinks regarding holding the share price at or the share at the current price, or whether there's any big upside to it.
Let me talk a little bit about the rare earth situation in China. For the moment, and Malaysia as well, one has to remember that Malaysia invited Lynas to do their work there. Now, the International Atomic Energy Agency has given Lynas a 10-point correction, if you like, or 10 slaps on the wrist, and said, we want to see a clean-up plan when it's all over. We want to see what you're going to do with the wastewater. There's a whole bunch of things that they need to improve on, but nowhere is it a deal breaker. This isn't over for Lynas by any stretch. In terms of China and in terms of rare earths, the demand for rare earths globally is insatiable. The need for it in all our devices, it's everywhere. We're looking at it right now on our computer screens. It's what makes the magnets that make our phones vibrate when we put them on silent. They're all over the place. The colours on our plasma screens, they're everywhere. Now, what's China doing? Just a bit of background. China is consolidating its production. Why? Because there's been a lot of black market production of rare earths. If you own an iPhone, most of the rare earths in your iPhone have been black market rare earths. They've got out, and the government is trying to consolidate it. They've put together a super company, if you like, that will be the governing body, if you like, for rare earth production. Until that's actually rectified, until they know what they've got and how much they produce, then it's in their interest to keep prices of rare earths high. Do I think they can go up another 300%, 400%, 500%? Probably not, but I'm no good at predicting these things. Yeah. Until that happens, then there's a terrific incentive for companies to make money and to bring production forward. Now, Lynas is the closest to production of any company outside of China globally.
2012, isn't it, I think?
Exactly. So what do I think they're worth? Well, you're going to be shocked by this, but I think they could be worth as much as $7, $8, $9 in 2012, 2013, if rare earth prices stay where they are. And I'm the first one to say to you, I don't know whether they will or not. That's what they could be worth if they earn what they could earn based on current prices.
Okay. Wonderful. So it looks like a very optimistic place.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.